Um, so let's begin. So let's talk about what credit is, right? And in a nutshell, for you guys to kind of get an understanding, it's kind of like it tells the individuals about who you are and how you approach your responsibilities. Okay. Now, it doesn't say everything, and not every contractual agreement that you get into is going to show on your credit report. But it does point out some of the major things that most people want to see in terms of any type of installment debt. And I'll get into what those areas mean. Any type of revolving debt, mortgage debt. If you have any judgments, if you have any liens, we'll get into what each one of those things mean. But that's what the credit report is going to talk to you about. And so your credit report is your way of kind of introducing yourself to anyone that is interested in getting into a relationship with you. And so that's why we want to make sure that we allow you to make better decisions on that. And if your credit score is high, that's great. If your credit score is low, that's great too, because that means that you now have the ability to do what it takes to get you to where you have to be. So never ever be down on yourself for any point in time where you think that you are in your credit journey. So let's talk about some five factors that play a part in your credit score. The first one, as you can see here on the slide, is payment history. And that's 35% of what makes up your credit score when it comes to credit. And so what makes up payment history? How you've paid your bills in the past, and a long history of making payments on time and not missing payments have more of a positive impact. So let's talk about that really quickly. So if you recently opened up 3 credit cards and you've been making your payments for the last 3 months, you probably feel good and you're like, I'm doing the right thing. And that's fine. But it's not going to have as much impact on your credit as if you would have had something, let's say, that you've had for the last 5 years and you've been making payments for the last 5 years on a timely basis. That's going to have a bigger impact on your credit score because it shows over time what you have done consistently. If that makes sense, give me a thumbs up. So that's why payment history truly does have such a large impact because it shows over time what that looks like. Now, if there are hiccups along the way, it does it impact your credit score a little bit? It does. But if you get right back on that horse and keep going and continue to make those payments, you will be able to make up whatever has happened over that time. So try not to be down on yourself and go down the rabbit hole of, oh my goodness, I may have done something wrong. We always have to have the approach of, let's just keep going. Things happen. We all know they do. So let's keep going, right? So that's payment history. The second one that we have here is amounts owed. That's about 30% of what makes up the score. Let's talk about what that means. It's the amount that you owe on the credit lines or the credit sections that are on there that are on your credit report. And it's the second largest contributor to your score. The best scenario is low credit utilization, right? So what that means is that if I have a line of credit of $1,000 and I've only used up 100, that's low credit utilization. And you want to shoot for low credit utilization because that means you don't really have that much of a need or that much of a desire to pull from these credit areas. You're able to use what you have in terms of your capital, your cash flow to handle the responsibilities that you have. If you have a credit line of $1,000 and you have used up 750, that means you need to pull from other areas in order for you to meet your obligations. And so that's where they kind of assess the risk in what is going on in your life. Okay?
Can I
So
ask you
that's
a
why we want to shoot for that. Yes, please, Stephanie.
okay, so when I've never done this before, but I know that there's options where you can get like consolidation loans and stuff like that. How does that play into that manner?
So let's look at it this way. So a consolidation loan means that what you're trying to do is you want to get rid of the debt that you have at a quicker pace, right? Maybe the interest rates that are on your current credit, the credit that you have may be too high, right? And so you're trying to look for a way that you can pay that debt off. I think that that's perfectly fine as long as you do exactly what it is that you're trying to do. If you get a loan of some sort or where it is saying, I'm going to pay off this debt, you need to do that. And although the utilization of that particular item is going to be high based on what you're trying to accomplish, the fact of the matter is that you're going to get rid of your debt at a quicker pace based on doing this. And so the goal is a better goal than continuing to pay this years over years over years and not getting rid of these credit obligations. Does that make
So,
sense?
so ultimately, it may have a negative impact in the beginning,
Initially,
but in the long run, which is what we're looking for here, is it will be more beneficial.
because you want to get rid of that debt, that obligation to that debt
Yeah,
over time.
get all the weight off my shoulders.
Yeah, yeah. It's always good to keep maybe one piece of debt that you've had for some time where you have a very low balance. It shows that you have history, one or two pieces there that shows that you have history, right? I wouldn't say to necessarily get rid of those, but if there's any debt that has been lingering and it's not good debt, it's hurting, then yes, you want to look at a way for you to get rid of those pieces of items. Okay.
Thank
Yes,
you.
Vanessa.
Yeah, my question is, what's the difference? Is it different from refinancing? The console?
You talk about refinancing your credit card debt.
Yes.
Okay, we're gonna get into that a little bit after this. I want to get through these basics and we'll talk about refinancing.
Okay.
Okay.
All right.
All
Thank.
right. So we're gonna put a pin in that.
Okay.
So let's talk about the next section. Let's talk about new credit. So new credit, that makes up 10% of your, one second. Let's call you back. I have to call you back. Sorry. So let's talk about new credit. So new credit is any newly established accounts or even inquiries can impact your score. So what that means is that even if you haven't established credit, if you are shopping around, that lets the credit bureaus know that there's a need. And so even those inquiries into credit card debt, even if it's not established, can impact your score. Okay. And so those new accounts as well can impact your score. Now, again, what I mentioned to Stephanie earlier, depending on what that is and what your end goal is, because you have to have a strategy, right? You have to think about you have to look at everything that you're doing going forward now as a strategy. We don't want to make impulsive decisions. We want to make sure that we are thinking about the end goal in anything that we're doing here. So if your goal of opening up this credit is to pay off credit card debt or to do something that is going to have a positive impact, then obviously the purpose has a bigger and a greater impact than what may happen initially to your credit score if you open up new credit. Okay. So always think about that and ask for advice because asking for advice is going to help you make better decisions. Yes, Stephanie.
What is the main difference between a hard inquiry and a soft inquiry?
That's going to be in my presentation as
Oh, we
well.
put a pin in that one too. Okay.
All right. So I'll get into that too shortly. Let's go on to the next one. Types of credit in use. That's another 10%. It helps your score to maintain a combo of three types of financing. And I mentioned that when I talked about them, right? Revolving. So anything that revolves, which means it goes back and forth, that's usually your credit card debt. You use, you pay back. You use, you pay back. That's revolving debt. That's credit card. Installment. That's when you're given a lump sum and you're paying it back on a monthly basis, right? That's an installment loan, usually student loans, that kind of thing. And then there's secured loans, which means it's secured by some type of collateral. What would that be? A car loan, something like that. So those are your three main areas of types of credit. And then last and but not least, the length of credit history. So the longer you use your credit responsibly for, the more of an impact it will have. So the long and short is you make your payments on time over extended periods of time, it's going to impact you positively. Okay? We're going to go on to the next slide. Let's talk about understanding your credit score and what a credit rating is. I think this is one of the areas where people get the most, they're trying to understand, what's the range and why. So we have it here. It starts from as low as 300, going as high as 850. And depending on where you lie, you will see on how they're going to view your credit history. All right. And so when you are applying for a mortgage, you have to understand what's happening here. You're asking a lender to say, we are confident that when we give you this money, we're going to recoup what we have given you, and you're going to continue with what the contract that you signed with us. That is what they're asking to see. And the only way that they're able to assess that risk is by looking at what's going on with your credit. In some ways, you can explain if there is a one-time occurrence, something that may have happened in your life, and it shifted some things in your life. What as someone in that industry, we'll put together a letter to say, we all know how life can be at times, and this is what occurred. But since then, they've shown the ability to make payments on time, and they are someone that we feel is credible and should be allowed to be lent this money, right? That can happen. And so when you look at your credit score, you're going to see where you lie at this time. And depending on where you are, you may feel like, okay, I'm shooting up, I'm on my way. Just understand that no matter what, you have room to grow and we can get to where we want to be. So you always want to be, if you want to feel comfortable and confident, you want to be in that good to excellent range, right? You want to be 690 and better. Because 690 and better means that you have shown that you have honored your obligations and that you have paid your bills in a timely fashion. The higher the score that you have, the lower interest rate you're going to have, because that interest rate is essentially their way of saying the kind of risk that may be for you. Any questions at this moment?
So I don't have a question, but I did wanted to, I guess, make a statement.
Sure.
So my credit history is I'm about to be 34 and I have over 24 years of credit history. Because when I was 10 years old, my mother got me a credit card under her name. She was the main account holder and it's still active. So by the time I was 18, I was able to get a $10,000 luxury loan to buy a motorcycle. Something most 18-year-olds don't have that opportunity to do. I annihilated my credit. So, not up there anymore. I'm not in good or excellent. I'm, what is that? Fair. I'm fair. But,
Necessary.
but I guess my whole thing is like, and I guess I want to share this for Vanessa because I want you to know this too, that this is an option, but you have to be careful with it because if your children are on that credit card line of credit and you don't make those payments, you are doing them more harm than good. But if you're able to make those payments, even if it's something so small and simple, like maybe I don't know, maybe once a week you fill up your gas tank with it and you pay it off at the end of the month. And your kids happen to be on that account, it's going to secure them like a decent amount of credit history from the beginning.
Oh, okay.
And I'm speaking because my mom did that to me, and I know that I am not in that position right now to take that risk because sometimes um I got to use my credit and I don't want it to affect my kids. So I'm not there yet. But ultimately I want to get there.
Yeah.
Just,
Completely understand.
yeah.
Absolutely. I will tell you that for myself, that when I graduated high school and I went into college, that's actually what my parents did for me. They had a credit card that they gave me. My name was on it. And yes, it was able to build my credit history. And it also prevented me from not falling into the trap of the credit card companies that are on the college campuses that are trying to lure
Yeah.
kids into getting credit.
At
So
like 24.98%. Yeah.
unfortunately, these college students don't even realize what they're getting into. They're just looking to, secure something. So yes, to your point, it is something that you can do for your children when they get to a certain age to help them build that credit history. Um, But what I will say to you is that your story is not, you're not the only one that has had that did this to themselves, especially at 18, 19, 20. Those are, I can only tell you the amount of stories. But what is wonderful, is that as long as you continue with the spirit that you have right now, which is that you are looking to you have a goal at hand. I know you're going to reach that goal that you have. That's what you want, and that is what you will get. All right. So please stay the course. All right. So with the credit score, the goal is the higher that you want to get as high as you can for your credit score, because the goal is to secure the lowest interest rate possible and also the lowest down payment possible. Those are the two things that you want to look for, right? So, moving on to the next slide. What is a soft inquiry? So there are two types of inquiries when it comes to when someone pulls your credit. There is a hard inquiry and there is a soft inquiry. The reason why, for the most part, a soft inquiry would be probably the best way to do that, or to take a look at credit, is because they're not pulling from all three bureaus. Well, what are all three bureaus? What are you talking about? There are three bureaus: TransUnion, Equifax, and Experian. Those are the three bureaus that pull your credit. If someone is looking to take a look at your credit or get a snapshot of what your credit is, it would be best that they just do a soft inquiry where it's only one or maybe two at the most that they take a look at to get an idea of what's going on. And when you do that, the impact to your credit, it's nominal, it's small, because it's not like you're like, I'm going in and I'm going in strong, right? They're just trying to take a little peek at what's going on your credit. And so it doesn't have as large as an impact. And for the most part, you won't see that inquiry on some of the credit reports that are being pulled. Okay. So a soft inquiry is usually, for myself, if there's a new client that I meet, when I'm meeting with them, what would I do? I would pull a soft inquiry just to kind of get an idea of what's going on, instead of jumping in and potentially putting a hard inquiry on their credit and impacting their credit. Okay. A hard pull. We talked about the three bureaus: TransUnion, Equifax, and Experian. A hard pull means you are pulling from all three. All three are coming in to what is called a tri-merged credit report, which means this credit report will have information from all three of these bureaus, and they're going to give it all: the good, the wonderful, the amazing, and the not so good, and the not so wonderful, and the not so amazing. Okay. And so that is why an inquiry like this, which usually it would signify, confirmation and seriousness of trying to secure that credit. That's why you're going to see that hit your credit. And that's why the impact on the credit is going to be so substantial. Stephanie, you have a question?
I do. So I know that the difference between soft and hard credit inquiries, not only is it the amount of credit bureaus that they reach out to and pull, but they also have a difference of time that they stay and affect your credit score. What is the difference between the two, time-wise?
So, like I mentioned previously with a soft, depending when you pull a soft report, it may not even show up because to the credit bureaus, it doesn't signify seriousness, right? It doesn't signify that this person is actually looking to secure a debt. It may just be one of your current creditors taking a quick look to see what's going on. It might
It's
just
like
be a
window,
little. Say it again.
it's like window shopping.
Yeah, it's like a little glance, like a little like, oh, let me just take a peek, right? It
Okay.
does not to them signify any concern or ability to question what's going on. If you pull all three, you're definitely looking to secure something.
Okay, and about how long does a hard inquiry stay on, give or take?
Honestly, it at more than a year.
Okay.
It because it shows history. It shows what's going on. It shows how many times you've gone to someone. It shows, if you're looking, let's say, for a car loan, right? And there's 15 inquiries. Why would I need 15 inquiries unless I'm having a hard time finding what I'm looking for, right? These are the kind of things that it signifies and they get concerned about.
Same instance, wouldn't it be also like kind of smart? I mean, I wouldn't necessarily like go and dive that deep with 15, but wouldn't it be smart to like kind of shop around a little bit to see what different offers you have comparative than
So
out of desperation to just jump at the first offer given?
absolutely, but there's a way to do that without each one of them having to run your credit. You can pull your own consumer credit to give them an idea or a gauge where your credit score is.
And
And
that's
you can have a
free for
conversation
them.
from there. You don't have to be forced into allowing them to run your credit until you're ready to move forward with that process.
Okay.
That would be my suggestion.
Okay. So like you're basically suggesting, like freecreditscore.com. You could do that once a year. Pull
Yes.
or
You're
if you
allowed
get
to pull
denied
your own credit and to look at your own credit and get the credit scores. And you do not have to allow each and every one of them to pull your credit.
okay. Because I also realized, and I'm sorry if I'm like taking up too much time, but I also
No, it's
realized
okay.
that
We want you to get your questions answered.
thank you. I also realized that like sometimes like my credit score, it changes between, I feel like we all have Credit Karma these days. So between Credit Karma and, sometimes depending what bank account I have, they offer me the opportunity to take a little peeky at mine. I know that if you get denied for something, they're like, hey, you got denied because you're delinquent on a lot of stuff, and just like, oops. And they're like, well, you can get a free score out of that though. So I take advantage of all of that, and my numbers, it's not just like by like a point or two. It's a drastic difference, I feel like.
Talking about between each bureaus, or are you
Or
talking about
between
when
like
something
credit card
happens?
between like Credit Karma and what my bank tells me and what free
Oh, I
credit score
see what you're
tells
saying. The
me,
difference.
there's
Yeah.
there's a huge difference. Like one of them is sitting there saying, and I really don't care. One of them is saying like I have like a 592, and the next one is telling me that I have a 618, and it's not between the bureaus. It's just between the platforms that I'm using to acquire my number.
Okay, so let me give you a little bit of better idea of what that is. Each platform may plug into a specific bureau. Credit Karma may use Experian. Another platform may use Equifax, and they all have their own science on how they calculate your credit score. So that's the reason why there's three different bureaus to give three different perspectives.
Hmm.
So it kind of gives you a guide and a range.
Which
But
is
if
the
you were
most
to look at a tri-merge score and see all three of your scores, you would be like, wow. That's why, from the mortgage perspective, we take the middle score as the determining score for your interest rate.
okay, so the median. Um, so which, and I don't know if you actually have an answer to this question, which bureau out of the three is the most gentle?
Oh, none of them are gentle. It's not. No, none of them are gentle. What I will say is that I can't tell you how they're able to calculate. I can't tell you how they are able to calculate your scores. What I can tell you is staying par for course. Do everything possible to maintain a credit history that is without any challenges. That is what I understand that life happens and I get it. But one thing I can tell you about credit is that when there is a negative impact, that negative impact hits hard.
Yeah, it's like a GPA. You get one
Yeah, it
back.
hits hard.
It's just
And
like
then it's like
go figure how you.
it's a bit of a crawl to come back, right? It's like, if you pinch me, I'm gonna be like, ow. And now I'm hesitant. Like, I don't know. I'm waiting. I'm waiting before I can trust that you deserve for me to give you this. And it's a little bit like that. It's like they're waiting to see, is this going to be a repetitive thing or is it just a blip? And then we allow them to get back to where they need to be. That's how you have to kind of see it and look at it.
Okay. Thank you.
You're welcome. So let's go to, so that's our final on credit in terms of that. But I want to make sure that we, ultimately, the goal of this call tonight was to give you and to make you feel comfortable about how you should view um, obtaining credit and what's going on behind the scenes when they're looking at your credit. And don't get down, right? Like if you get denied for credit, understand that in some situations, it's just their way of assessing risk. But you will eventually get to the point where the response is going to be a little bit more forgiving because it just takes a little bit of time. And I see the two of you here. You are invested in what you're trying to accomplish, and so you're going to definitely get to the point where this is going to really work for you.
Team single moms. Woo!
So, do you have a question for me? I believe you had a question about refinancing, right? Yeah, right. Okay. So,
Yeah.
refinancing is kind of similar to what we talked about. Now, if you have a piece of debt that you've had for some time, and let's just say that there is a possibility that they're going to reduce your interest rate. A lot of times they'll do that on their own. They see the payment history, they have the ability to look into your credit. They will reduce your interest rate in some cases. And if they haven't, you can always go in. They shouldn't have to do much. But the only time in terms of refinancing any type of revolving debt, that I don't necessarily recommend, right? Let's get to the point where you're making your payments in a timely fashion, and that will happen. When it comes to a car loan or anything like that, if you're looking to refinance a car loan, that's perfectly fine to do that when you're looking to obtain a lower interest rate, so that you're able to pay off your debt at a much faster rate. There's nothing wrong with that. Again, is it going to hit your credit? Is it going to impact your credit at the beginning? Yes, but we have to pay attention to the goal. Our
Yes.
purpose is to pay off certain debt and be done with that. You only want to keep two, maybe three pieces of credit at the end of the day. There's no reason for you to have more than that, because if it's there, it means it can be used,
Yes.
right? So you always want to kind of keep that in mind.
Okay. Thank you.
So I'm going to check in with Judy and Raritan. Do we have anything else that you would like to touch on? Because I feel like we're in a good place.
Mhm.
Well, I actually had a question.
Great, go for it.
Just curiosity here, because I bought a car shortly, last December or whatever. I did like 5 hard inquiries within a 2-day window because I was told that if you do them within a short window, that they will count as one. They did not. Is that normal?
Never know. If they're 5 different individuals, those are 5 hard inquiries.
No, it was at 2 different dealers, but 5 hard inquiries total.
It was only 2 companies and 5 hard inquiries.
Because they were like sending it to different lenders, I
Yeah,
guess.
that's what they do. They send it to, let's just say, I'm just going to throw some out there, Capital One, City. They'll send it to different people, and that's what that is not. They're going to be hard inquiries.
Oh, so that's just an urban myth, huh?
No, they're going to be hard inquiries. They're different entities pulling your credit.
Wow, what a bummer. That's still on my credit right now. I'm like, no.
Yeah, that was unfortunate that they told you that. That is not.
Makeda, I have a question. How long does bad stuff stay on your credit rating?
7 years.
Oh, thank you,
So-
Stephanie.
You got to be careful with that. There really is not and they're selling this to people so that people think that after some time you should remove my bad, the bad, the bad stuff that's on my credit. Not everyone is going to remove it. It's not that it doesn't remove it. It's the question is, should it be a part of the decision on whether or not they lend to you? So for instance, if somebody has a bankruptcy, and depending on what the bankruptcy is, after 7 years, they will consider you to be able to obtain another mortgage. It's not that it's going to be removed, it's just how it's going to be received and what they do with that information. So there are some inquiries, there are some there is some bad history that can be removed over time. Like those small, the Macy's credit card or these little things, if you had them for 7, 10 years, they may fall off after some time. But to get them removed, they're not going to remove it because it's an indication of what you've done.
Mhm. Okay, next question. What
I want
about
to say
those
one other thing.
credit
I want to say one
repair,
other
credit
thing.
repair? You see some ads in the paper.
Yeah.
They're like credit repair.
Yeah.
Is that like legitimate, or is that
This may help you. There are companies that can help you depending on what's going on in your credit. They're able to look at your credit and say, okay, if you pay down your debt by this amount, it'll increase your score. And so they can go through your credit and do certain things like that. But if they say to you that if they remove certain things, they're taking advantage of certain guidelines that the credit agencies have. For instance, if you dispute something, they have to take that particular item off, whether it's right or wrong, and they have to investigate it. But best believe, if it is correct, it's going back on.
Got it? Okay, because I see these ads in the paper, and people have asked me about them, and I don't know what to say. I don't know.
No, not all of them are legit. They're taking advantage of people. People think like, oh my gosh, I just ran my credit, it's off. And that's why when we do mortgages, that we run the credit at the beginning, and before we close, you
Right.
run the credit again. Because and this is one of the reasons why, because they're out there doing things like this, and then before you close, all of a sudden you're like, well, where did this come from? And you get another perspective. Yes, Stephanie.
I don't know if I should actually ask you this question, but I'm going to anyway.
It's a
Don't-
safe space.
don't get mad at me. So I know that there's a certain amount of disputes you can put on your credit. So if let's say you are going to be purchasing a new vehicle and getting a car loan, you can dispute, let's say, 3 things and get them temporarily removed, whether they're right or not, to kind of get bypassed. Is that
No. I said this is a safe space because I want to make sure you really, if this is important, right? And so you have to understand that if those things are on there, they've already impacted your credit to some degree. So even if you remove them, they've impacted your credit to some degree so far. You can remove them. You're playing the game. You're not the only one. A lot of them do that.
it's not by choice?
No, I understand. No, like I said, no judgment here. No judgment zone. Okay. Um, but I want you to get to the point where that's not something that you even have to consider.
Yeah, me too.
You
One,
understand? Because and listen, you're trying to find a way to get what you need to get so you can go where you need to go. But we want to start to get ourselves out of these places where we're taking risk.
yeah.
We want to reduce the risk that we're getting ourselves into, because at the end of the day, it's going to get slapped right back on your credit.
So now let's say if unfortunately that's the path that I took,
Yeah.
right? And we have an agreement, are they able to kind of go back on their agreement if they see a notice in my credit?
It really depends on what you're doing, if you did it, what you did it for. If it's for a car loan, and something pops on there, once a contract is signed, you're agreed upon, so it really depends on the terms of the contract that you signed. You have to make sure you read the fine print, make sure you understand what you're getting yourself into. I can tell you, when it comes to a mortgage, 9 times out of 10, we're going to find out before we close.
Yeah, I mean, I was pre-qualified a few years ago with me and my ex-boyfriend, and I didn't necessarily do it the right way because I'm the person that doesn't doesn't really believe in banks all the time. So I like to keep my cash on me, and I'm an envelope kind of gal. And
We're going
I
to talk about that too, Stephanie. And I'm sure Raritan can't wait to get you on that call. We're going to talk about that too. But go ahead.
and I found out you can't just take like $7,000-10,000 in cash and just throw it in the bank and get a mortgage. You can't do that.
You can't. It's something called seasoning funds.
Yeah, I learned that one the hard way.
Yeah, that's okay. That's why I talk about education. You got to understand why these things are the way they are, and how to get ourselves away from certain things we might have been, taught or learned. So, yeah. So if there are any more questions, I would be more than happy to answer them, and I will also pass this deck over to anyone that wants to have access to it, just as a reference.
I have a question, Makeda, if you can maybe help Stephanie a little bit.
Of course.
So rather than stuffing thousands of dollars into your mattress, do you have a recommendation, like a bank, a credit union?
Can I ask what the concern is with the banks?
I don't have, I mean, Steph.
No, I mean for Stephanie.
Okay, so
Sorry, guys.
I
Go ahead.
have not had good experience with banks because it's extraordinarily frustrating because when like someone that is financially sound, right, they never have to see an overdraft fee, and I'm over here fighting overdraft fee after overdraft fee over account fee, and it's just like fighting, and I'm like, and it's just like I'm going back and forth, and it's just crazy. So like I like credit unions, but credit unions are very specific. You have to meet certain standards. You have to work for a certain company or live in a certain area, or they have their own qualifications to get a credit union. I am all about credit unions. I think they are so awesome. But I don't know. I'd rather have like cash is king. That's, I guess, in my head, that's what it is. Cash is king. So you're on mute. Makeda, you're on mute. Now you're extra on mute. Can't hear you. Nope. But you're not on mute because your
I can't hear her either. Try again, Makeda. Say something. Oh,
I can't hear you either. Now, okay, unmute.
Now?
Yeah,
You're good.
Woo!
You're good.
She's
Weird.
back to the game.
So yes, cash is king until you need someone else's cash. So, I wish I had specifically banks that I can say would work for you, but you're gonna have to dig in and do some research. You should not be getting yourself into any account that's going to require a minimum balance from you, because you're not you're just giving money away. You're giving away your hard-earned money. Okay?
Just opened up a credit card, right? And it didn't have like a high yield or a high value. It was $300 that they gave me, and I didn't even use the card. Okay? And I got hit with a statement for $75. So that leaves me with $225, and I didn't even use
What's
it.
that fee for? Is it a usage fee? Did you read?
Fee.
Say it again?
It's an annual fee. An annual fee, a yearly fee. Yeah, I know. My credit.
Yeah, you're gonna have to you gotta read the fine print. And that's unfortunate because you haven't even used it and you're already paying back money that you didn't even use. And that would frustrate me. Um, you
And it's like
need to read the fine print when you're entering into some of these cards.
I usually do, and I
Yeah.
did this one. And
And
it's
so I'm the kind of person I call myself Petty Patty. Because that card, listen, I would pay that $75 back so quick and move on because you're not going to take advantage of me. You know what I mean? And like,
the minimum payment was $30. So
yeah,
you're literally making interest of like almost 25% off of the remaining.
your annual fee. There's no way. I would have been like, again, thinking about the long-term goals, I might take a hit for opening up another new credit, but you're not going to take advantage of me. You're not going to lock me in and push me in a corner. I'm going to pay that bad boy off and find something else that's going to work better for my life. That's not okay.
So with that said, how does it reflect when you open up a line of credit or a credit card and then in a very short time close it?
Like I said, there is going to be a negative impact. I won't lie. There is going to be a negative impact. But you have to ask yourself, am I going to sit here with a card that I'm not even going to have access to the entire line because you just hit me with a $75 annual fee that I have to now start paying back? So I'm looking at the big picture here. So yes, it's going to impact you initially, but you're trying to get yourself to the point where you have healthy debt. You have debt that is being used in a healthy manner.
I mean, I might as well keep it for the year at this point. I paid for the year.
Okay. Because they're going to get interest from you. It's not just the $75, they're making money off of it. Yeah, there's no way. So in the meantime, I would look and start to take a look at some other options, depending on what it is that you're trying to do, and see if you can find another option for yourself that's going to serve you better.
I honestly, I just got it to kind of boost, try to reestablish my credit a little bit and build my credit a little,
Yeah.
and have something to fall back on for emergencies. You know, push comes to shove, it is what it is. I got to use it. I got to use it.
I understand. It's just that interest that they're going to be that they're getting off of their annual fee is crazy.
And then I do have another question. I could be here all day asking questions, but so I don't know if this is true or not, but someone told me that um, the consistency with payments holds a decent amount of, it factors in a lot. So rather than, let's say paying $30 once a month to a credit card, if you were to pay $10 every week to that credit card, that is now 4 payments comparative to 1 payment. Does that? Can't hear you again. Nope. You're not muted though. I can see who's muted. You're not muted, but we just can't hear you. Nope.
Mine shows her muted.
Hello?
Ah,
Now you got it.
he's back. Welcome back,
Okay.
Makeda.
So that doesn't, all they're worried about is you meeting your obligation by the date that you agreed upon. The amount of payments you make to get to that doesn't really matter. They just want you to meet your obligation. If you pay off the debt faster, that looks good. That's great too. But if the obligation is 50 and you make 5 payments up to the due date, it doesn't impact you any differently. But also at the same time, if you know the kind of person that you are, and if that allows you to meet your obligations, go for it. You just want to make sure you stay with the obligation that you have.